Hello. Welcome to Al Stock Trades. In this video, we are doing a live stream here, and we're going to go over the Bank of America Healthcare Conference for Clover Health, see if there's any insights. I believe this was after the quarterly earnings report. If you can do me a favor, please post this on StockTwits and all the other social media platforms so more people can hear about Clover Health, as it's I one of the most undervalued stocks that you could find in the market. I think once they hit profitability and that switch gets flipped, we're going to see some ultimate gains. First off, how's everyone doing? I hope you guys are doing great. This week has definitely been challenging with the markets. A lot of the mega cap stocks are starting to take a beating. Inflation, we did see a slight cool down, but definitely over analysts or economists' expectation. And things are just getting a little bit hairy and dicey, and a lot of retail investors are getting margin called, and a lot of them are selling out of the market. So I'm going to share with you. How you doing, Robert? How you doing? It's a privilege. Thank you for joining. Let me add this here. So, as you can see here, this is the smart money, dumb money confidence spread. The blue is smart money, and the red is dumb money. And as you can see, if you don't recall, a week ago, 2 weeks ago, when I started to see this go down and this go up, kind of diverging, I said, "Hey guys, check this out. We may fall off a cliff here because usually dumb money starts selling, and smart money starts accelerating the downturn in order to capitalize on the downturn." And what we see here now is dumb money, and the way this data is collected is dumb money are retail investors. They're newbies. They're people that don't have any market experience. Sadly, Wall Street has data, and hedge funds and people that participate in the market can purchase this data. And I'm unfortunately, dumb money retail just started selling. And unfortunately, the smart money were just able to capitalize on the downturn. Every time stocks went down, these smart money institutional investors doubled down. Corporate insiders kept on buying and essentially being bought at a discount. So I hope this makes sense. We do see dumb money start stepping in now. So we could see a reversal. So there's that. I'm going to be going over this really quickly just to get people trickling in, and then we will go into the Bank of America conference live. But I do think that you will love the information I will be giving you now, because it is very extremely bullish. I don't know how much I can overstate that. So the S&P 500 after the New York Stock Exchange, if there's new highs to lows of late, if it dropped to less than 30%, also as a NASDAQ, if it drops negative 33%, we tend to get these signals that are placed throughout our history, all the way from 1987 to 2020. And we got the signal just recently on the NASDAQ, I believe. And from this, and whenever we get a signal like this, if you look here's 1 week out, 2 weeks out, all the way up to a year out. If you look down on the year, you can see that the stock market performed 32% positive gain 94% of the time. So whenever you start getting these huge corrections, you get to a position where you're setting yourself up. Money is made during a bear market, during a recession. Money's made at this level. And this is where the real investors come in and say, let's go, right? Unfortunately, you may have seen this, a lot of YouTubers and whatnot, they're gone now, right? A lot of them are gone because that's it. I mean, this is it. They came in the market brand new. They don't have any experience. They don't know data. They don't, I hate to put the people down, but you want to buy when there's blood. You want to buy at these levels where I mean, just look at the 2008 recession. You know how many signals we got in 2008? And then would you look at that beautiful V shape? Slower V for sure, right? So this is definitely a type of thing you can look at to help you. And if you look at the panic button has been pressed. Okay. Now there's different levels of panic. Okay. If we have panic below 1, which is right around here, panic below 1, you get an average return of 7.5% annualized over the year, 85% of the time. Okay. Now, if you get panic above, 1 to 1.5, you get really modest returns. In fact, it's only 6% of the time. And then once it's above 1.5, usually there's some huge something happening with the economy, such as the 2020 pandemic, where we don't really know when things are going to happen. The pandemic was a fluke. Usually stocks don't go up that high, and the Federal Reserve just unleashed cash, and it just increased the valuations. But now let me tell you something. So as you know, and as you've realized, when I make price targets on our Stock Alerts and Mastering Stock Market course, when I give you guys price targets, I do it again, it's my personal opinion. I do it to a point where I always try to be ahead of where the market goes. I always try to give a price target before Wall Street pumps their money. Like, for example, ExxonMobil, I said, hey, this stock's going to go really great. Definitely get into it at like, what, 40, 50 bucks, whatever. Now it's 80, 85. I did a hard sell at 80. I don't care if it goes over that. I don't care if it goes up to $1 million. I don't care. That's value investing. But I want you to pay attention to this. Every time this panic button gets pressed, we already know technology stocks are not the stocks to be in. Get out of technology stocks. This is Jim Cramer. All these issues, these people that just manipulate the market. And he's probably getting paid hand over fist to manipulate the market on CNBC. I want you to focus on the 1 year here. I want you to take a look at this 1 year. All right, guys? And go down and tell me, where is the highest return? Okay. Where is the highest return? Let's try to see if we can find anything above 20. Oh, there's one above 20. Let's see. Technology. Would you look at that? All right, let's go. Let's go find another one. What's another one above 20? What's this one? Healthcare. And I'm sorry if I'm being annoying here, but healthcare and technology. Healthcare and technology. Clover Health, okay? And that's my sniper. And it's hard. It's hard to snipe a shot like that that's 3-4 football fields away and trying to basically see this. But from what the data I see, healthcare, technology, okay? All right. Let's go ahead and this is all I had for you for the quick presentation. We're going to go into our Clover Health Bank of America healthcare conference with the CEO and president. Hello. How you doing, Irish? Hello. Almost getting there. I feel like I have to wait maybe years to, and that's the thing. That's the name of the game when it comes to investing. And it's a tough process. I personally like it because money is whatever to me. It's not. I know that sounds like cocky, but money doesn't mean anything. It mean these fiat currency. What I meant, like, I didn't mean it by saying, "Oh, money is just nothing." No. Money is just fiat currency. It doesn't have any value besides of what the military and the government and the people put in it. So that's why I like businesses, because you're buying a company. We have ownership in this business. And if this business succeeds, well, that's how generational wealth is built. So it takes time. It takes time. What's up, man? I'll set X on 2 million load of them. No. All right. Let me go ahead and remove this here. So we're slowly building up our YouTube studio. It's taking me some time. I'm waiting on a couple of products that are so incremental for this. And I just, we're just going to have to make do to what we have. And hopefully within 2 months, you'll see some drastic changes in our YouTube studio. If you like this content, please consider subscribing, liking, commenting, sharing, all that good stuff. It helps with the YouTube algorithm. Also, it helps me get to know my audience. So I'm going to go ahead and share a screen here, and let me see, Clover Health Investments. Boom. Okay, so now you guys should hear the audio. Let me raise up the volume. Money's nothing. It costs $8 for a pack of bacon. I mean, seriously. It is nothing. It means nothing. It just, the value of it changes, and you know, the best way to hold it is either owning companies. Obviously, you need to have emergency cash reserves. Money's money there, but in terms of wanting to build your wealth, you got to find appropriate business models to place it in. My recommendation for people that don't really know the markets and don't want to buy securities and don't want to put in the work is to just go index fund. It's like the easiest thing ever. Index fund, and then you're good to go. Like if I pass away and my wife, I'll just tell her, hey man, screw this whole thing, index fund. Because it's too much. It's a lot of research. It's a lot of work, and most Americans don't want to put it that work. All right. Hello, the earnings was good, but the price go down. I don't understand this market. Well, no, I mean, nobody does. But there's a lot of issues. You have Ukraine, Russia war. You have food prices going up because a lot of the wheat prices from, the Ukraine is being rendered. We have a president that is trying his best. I like to give him the benefit of the doubt, but is not in sync with what the American people want. Now he wants to do it. But again, hey, we're only a couple months out from an election, midterms election. We have midterm elections, which normally is not good for the market. Inflation at all-time highs since the 70s and 80s. So there's just a lot going on, a lot. Company I work for just bought out by Morgan Stanley. Well, that's good. Hell yeah. Go Morgan. Go Morgan. It's so expensive. Oh, yeah. I'm going to go ahead. We're going to play this, and then we're going to stop it. And if I find anything important, or if you guys want me to stop, just say stop. And then we'll go ahead and talk and have a discussion. And we'll go ahead and back to the questions and go back and forth. So I'm going to go ahead and play it. Please let me know if you hear it. Like say, hey, I can hear it. If not, like, let me know, please.
Everyone for joining us today. It's my pleasure to be introducing Clover Health. Clover is a technology company that operates one of the fastest growing Medicare Advantage health plans, as well as.
Okay, I know already. Clover Health is a technology company. You see, back in the day, when I say back in my day, like a couple quarters ago or a year ago, when they introduced Clover, they said Clover is is a healthcare company. They never emphasized the technology. Okay, it's a technology company, right? Remember, healthcare, technology. Those two things are going to outperform. All right, I'll shut up now.
Well as one of the largest direct contracting organizations in the country. Presenting today, we have Vivek Garipalli, who's the CEO. We also have Ryan Schmidt from Investor Relations in the office, in the audience. I think we're just going to jump right into Q&A.
Sure.
All right. So, so basically, we've seen that a lot of the companies who have gone public recently, who've been focused on growth, have kind of made a shift from growth into focus on profitability. Can you tell us kind of where you are on that trajectory and how you think about that pathway to profitability?
Yeah, I think, it's interesting just from a general market backdrop. Now you see a lot of, it's very similar to kind of 2000, where a lot of technology companies, putting aside healthcare that have been growing pretty quickly, are almost sort of like knee-jerk having to make that shift. I think from our perspective, especially coming into an industry where it's dominated by huge incumbents, there really wasn't really a concept in the public markets of a technology company operating in a risk-based model. Obviously, a lot of pattern recognition around technology companies servicing big incumbents. But the concept of a technology company potentially becoming an incumbent is very foreign to, I think, public market healthcare investors. So we knew when we went public that we would have to prove out growth, not only, prior to going public, but at least have that cycle. I think right now, a generally knowledgeable healthcare investor can conclude that we've got a pretty compelling growth model, just in terms of how we've designed our plan designs, open access in terms of going in or out of network as a primary in terms of primary care.
Okay, guys. So this is just very important. I just want to point out here. He said it very clearly. He basically stated that at this point, people that studied and understand a healthcare model, they realize that our business model is high growth, and it's working. Okay, we just saw recently some filings from SEC 13F filings. JP Morgan increased by a little. There are a couple of other shares, institutions coming in. And people are starting to realize that this company has a future. Its growth rates are growing at a rate of like this is just very difficult to find. And he said it better than anything. He said that normally it is very highly unrealistic for a technology company to become an incumbent. I'm going to say this one more time. It is highly unlikely for some tech company to become an incumbent in the healthcare arena. Okay? Very simple. You guys think about it. Taxis were the main go back in the day. Taxis were the incumbents. No one effed with taxis. Taxi services were like a legit mafia. You don't mess with them. Okay? An app came, technology company Uber, and it destroyed the whole industry. Taxis started filing lawsuits, the companies but then guess what? Innovation succeeded and it blew out a whole industry. So many taxi cab services went bankrupt. And now Uber is the incumbent. Clover Health will become the next Humana, the next, I pray, the United Healthcare. It will be the next incumbent, okay? And it's a tech company. We're using tech to be more efficient and be able to not only do it in the United States, but in the future, this will be available, especially the Clover Assistant, in other models. They give the Clover Assistant free to doctors, and it's almost, because you have to understand, it takes so much money to build a doctor. Millions of dollars go into creating a physician. It's not, don't think that medical school tuition is just $250,000, $300,000. That's subsidized by the state. Becoming a physician is so damn expensive. You're having millions of dollars of brain power of a physician go in this Clover Assistant and self-correct it. And the machine learning algorithm just keeps getting better and better every minute through every patient, through every diagnosis, through every input and output. Okay? All right, let's continue.
Super low cost in terms of CAC and extending into direct contracting. So I think from a shift to profitability is something that I think happens to coincidentally fit with the time, so to speak. But I think we would have had to make this shift irrespective, even if, let's say, we remained in a kind of a market bubble still, I think we would still be making that shift just because it's important for us to do. I think taking it a step further, when we think about our economic model, the goal is really to generate enough gross profit.
Very clear. Can you guys hear me? Can you guys hear this? Because I didn't share the screen. I'm going to share the screen just in case you guys, if you guys did not hear this, please let me know. Because when my picture was not showing. Okay, so please.
On our insurance line of business to cover the consolidated operating expenses of the entire organization. And the way we look at our non-insurance line of business is to take that gross profit, and that's what really will drop to our bottom line and generate a lot of free cash flow over time. Whereas a lot of the incumbents or even some of the other earlier stage MA plans have to have a very defined gross margin to generate that business value. It's not to say that we won't generate more gross profit beyond even our consolidated OpEx over time, but we have a big economic advantage on operating leverage. And I think a lot of insurance plans or with non-insurance lines of business, they're typically focused on one area or the other, and it's very much of not servicing physicians or providers. So typically, if you're an incumbent, you're very much having these individual lines of businesses that have its own OpEx structure, creating chaos within physician practices. For us, it's really land with Clover Assistant and then extend it across the physician's panel, starting with fee-for-service, extending it with third-party MA, really being that intelligence layer.
You know, it's interesting the way that you frame that, because definitely noticed during your earnings call, it seemed like there was a shift. You know, obviously you renamed your segments to the insurance and non-insurance, and then you started talking a little bit more about licensing technology and doing things. So like when we think about the way you just framed gross profit covering the business and then the technology kind of flowing through, is that technology a combination of direct contract, ACO reach, and licensing the technology? That's the way to think about that other side of the component as you laid out the profitability?
Yeah, and I think the way to think about, and we use the word licensing loosely, where it's going to be different in each kind of segment. So as an example, in or direct contract now, ACO reach for next.
So just very quickly, yes, to answer this question. So I've listened to Vivek so many times, and about 80% of the time, it's a lot of the same stuff, and he always puts in 20% something new. Yeah, so this is my first time listening to y'all. Like, this is like first time live. I just been really busy working on so many things. But yeah, this is me listening to you for the first time. So whatever I find out something, we find out together, we can talk about it. But now you can see Bank of America strategically said that the way you basically set up your earnings call, you kind of fragmentize it. You're like, okay, this is for the healthcare, and this is kind of like non-healthcare, software, licensing, right? And people now are starting to be like, oh, this is a SaaS. Oh, right. Oh, okay. This is right. Now people are starting to realize that this is going to be a huge tech company that's just going to disrupt the whole damn thing. And it's going to be great watching all the incumbents squirm.
Next year, the model we've deployed is Clover takes on the financial risk. We deploy Clover Assistant in the clinical programs, and we then share in the upside that we're able to generate over time. But even in that model, we work not just with practices, but MSO organizations, maybe smaller versions of like the Agilon type companies, because our real value add there is that intelligence.
Very quickly, just to answer this quick question, and it's not a dumb question. It's a legit question. For people that are on the call, I'm sure people are like, what's a SaaS? A SaaS is like a subscription fee for service. It's like you're able to provide a software that people are able to rent out for you. It's a business model that allows your company to be worth higher multiples because you get to keep more of that dollar bill. Because this license that you offer with this software, you don't have to, it's not something that you need to physically build. It's from a data center that is just basically composed of machinery that you just add chips to increase the bandwidth of your VNS server, right? And it's kind of amazing because it's not going to, the ability to make operational expenses is decreased because, for example, if you're like a food store and I'm selling tomatoes and all that, all these are operational expenses and my margins are tight. Having a software business, your margins are extremely huge, which is why Facebook has been successful over the years, because their software platform, they get to keep majority of their dollar. But then if you recently checked their stock price, it's been dropping because they're going into the metaverse, which is a more of a physical product that they're building that is taking a lot of their gross margins. So that's a great way to kind of evaluate the business there. So I hope this is a very good question. Not dumb at all. Very good.
Intelligence layer. So our monetization engine is really a function of what allows us to garner the most value. So just said another way, if we look at something outside of healthcare, no one would ever mistake Google for not being a technology company. They made a decision from a monetization perspective early days to generate ad revenue. The reason they did that, not only because it had a big TAM, but being able to offer that for free allowed them to create the most engagement and iteration to continue to optimize their search results. And so when we think about this from an extension perspective into, let's say, we're helping practice service third-party MA plans, we're not interested in being direct negotiators with those MA plans. It's really going to be up to the practices or those models. What are they comfortable with? Most doctors didn't become physicians to run a hedge fund. And so, while there's this big fascination with capitation, it's not something that the vast majority of practices are personally or emotionally comfortable with. So we're never trying to shove them into a financial model. It's really what makes sense for that physician, that practice, or that hospital-based practice. And then from our perspective, how do we ensure that we get the most trust with our platform when we deploy it? And how do we create an economic model with how they benefit from that third-party MA plan? And we're just behind the scenes on that end. And that's really how we look at it.
Yeah. So I guess, does that have any ramifications for, because it feels like a little bit different ways, this is how you're framing the economic models. Does it have any ramifications for kind of how we think about margins or the EBITDA potential of the company? Does that change the margin, expand the TAM? How should we think about it?
Yeah. So
But you see how does that expand the margins, affect the TAM, right? The gross margins. You see how I explained it to you earlier about why it is the SaaS-like model. It changes the whole business. So think of it in reverse. It's like Facebook saying no more metaverse. We're going to go back to Facebook. The stock price would go back up. It's that shifting to a hardware/insurance brick and mortar company that just does its simple incumbent style, old school style transaction of healthcare versus a tech company where it's like, oh my God, its margins are undervalued. You understand what I'm saying? The stock market, Wall Street, has been pricing Clover Health as a non-tech company. The stock, Wall Street, it's like pretty much, how do I explain? It's like telling Google it's not a tech company. That's what they did. And it was the most foolish mistake ever, because it's going to make a lot of people in our Discord group on this call, it's going to make a lot of people millionaires. Very simple.
So the TAM, the way we kind of view TAM, there's current TAM and future TAM. Future TAM, everyone says all the Medicare, all that sort of stuff. So I think the reality is you have to look at, in MA, you have to look at how many markets are you going to be in over time. So the reality is we're not going to be in every market in the country in the next 3 to 5 years, but we'll be in more markets in 3 to 5 years than we are today. And then you have to look at the product that you're offering consumers. So the main cash flow engine of incumbents today in MA are HMO products. Any incumbent that says they generate a positive operating profit on PPO, they're lying. They're just not. And so they don't know how to make money on the most popular product that exists today. That's a business problem for them. They're valued as if they're growing pretty quickly, but in reality, their growth has stopped and is actually declining. And on the PPO side, where their growth is, they actually make a negative operating margin there. And so we built our whole business model to have Clover Assistant drive financial value in an open access PPO model, not just a standard PPO model where you can go in or out of network to any primary care doctor at the same cost sharing. And that gives us, once a physician, even if they're out of network, gets to a certain level of Clover members, that allows us to go and get engagement on them using Clover Assistant. And so from a TAM perspective, whether it's in a county or in a state, we're able to make what I think a more intellectually honest argument that any consumer in that market that's interested in saving money relative to fee for service and maintaining that choice, we're a more attractive product. There's a financial sustainability around it. And then that starts extending when we actually start opening up alignment incentives with consumers to want to go to physicians on Clover Assistant. That's something we haven't introduced into the market yet, but is on our roadmap over time. That's something we may do. So when we look at our TAM, it's a function of what's actually financially sustainable. I'd argue the future TAM money relative to standard PPO
I'm going to repeat that.
Model where you can go in or out of network to any primary care doctor at the same cost sharing. And that gives us, once a physician, even if they're out of network, gets to a certain level of Clover members, that allows us to go and get engagement on them using Clover Assistant. And so from a TAM perspective, whether it's in a county or in a state, we're able to make a more, what I think, a more intellectually honest argument that any consumer in that market that's interested in saving money relative to fee for service and maintaining that choice, we're a more attractive product. There's a financial sustainability around it. And then that starts extending when we actually start opening up alignment incentives with consumers to want to go to physicians on Clover Assistant. That's something we haven't introduced into the market yet, but is on our roadmap over time. That's something we may do. So when we look at our TAM, it's a function of what's actually financially sustainable. I'd argue the future TAM for current incumbents isn't actually bigger than it is today, because they're going to bleed lives on the HMO side, and they don't know how to generate margin on the PPO end. So and then if we take it into the fee-for-service end, that's a marketplace where if the government said tomorrow, there's no more at-risk models, ACOs are gone, our whole approach is, we're just trying to deploy an intelligence layer there for physicians. So what's the new RFP or what's the new technology model there? We just saw this as an opportunity to deploy software. It's a really interesting monetization strategy for us and a way for us to get more operating leverage with practices. At the same time, there's a lot of markets that we're in where we have an ACO REACH partner where we don't have an MA plan. And that gives us a lot of signal as to, is that a market we want to enter with an MA plan now or later? And then when we think about extending to third-party MA, it's really fascinating, right? So if let's say it's a state.
Okay. So if you like this video here, please consider liking, subscribing, hitting that notification bell. But I want to just stop it really quickly and talk about something important, because this individual brought up something here. He said that 3.2 revenue this year, conservative SaaS multiples 7. We're looking at a $22.4 billion market cap. Yeah, around 470 million outstanding shares. $47 price target. Okay, great. I agree. In fact, I think it's going to be higher in the future, because you're looking at a 3.2 revenue multiple this year, right? But I don't think the stock market's going to heal up until 2025, until the inflation gets fixed. And we're talking like $11 billion. I think they're going to make $11 billion in 2025, right? And sorry, my wonderful cat wants to say hi, but we're too busy trying to grind in the Clover, okay? So they're going to be making $11 billion. So by 2025, it's going to be huge. But guess what? I'm on top of your analysis, my friend, because I agree. Let me stop sharing the audio version here, and let me just share with you the screen. And let's just go to, and by the way, free stocks, move down below, link down below. But let me show you something real quick here on our price targets page here. So if you go down here in our private Discord channel, you type it in price target Clover, you said what, $47? If you go down here, I upgraded it just recently. And if you look at it right here, price target, and I said with direct and without direct, assuming Elizabeth Warren gets her way. She obviously didn't. We're going with direct, $48. Literally $1 off of what you're saying. You did it correctly. But you calculated it an old-fashioned way using revenue multiples and SaaS, which you can compare it with other SaaSes based off of this graph here. But our DCF calculation works on all different types of stocks, even non-SaaS, which when we did this calculation, we never really introduced the SaaS component. We just basically introduced its growth rate. Its growth rate, it's abnormal because the SaaS was already integrated from the first place. That Clover Assistant was chirping away and working at its growth rate. Hence this artificial intelligence right here. Okay. You can't see my screen? Oh yeah, it's because I zoomed out. Can you see it now? Does the cat pick, does the cat pick stocks? Probably likes Chewy maybe. But no, I hope you can see my screen now, because this is really important. But please let me know if you don't see it. If you don't see it, please let me know. This is very important, because we're going to go in and we're going to redo this calculation here. Okay. So this is the 12-month PE. Okay. And if you look at this, guys, we're looking at kind of a 23 PE, 20 PE, so we were at a level where we're extremely high. Okay. We're at over 32. And then this is where Jerome Powell started printing so much money. And you can see the taper, 2018 taper, 2015 taper, all these taper tantrums that we've had. But then now we started doing the taper. And now it looks like we may still go through some down cycles. But it seems that the support line here is around 20, right? So if you were to take that kind of like a revenue multiple, if you look at the it's a SaaS. Let me see if I can show it to you. If you look at the SaaS Capital Public Index, it seems to me it's hovering around the same calculation as what we basically did here, right? The same calculations here, right? You can kind of see it. Kind of, if you were to paste it over, this looks at all the SaaS companies and takes a look at the revenue multiples. It seems that we may be hitting an average of 10 or going down at these support levels here at around 8. So if you were to look at the ratio between 9.7x revenue multiple of Clover Health, which we had, in fact, it went up to 12 revenue multiple, we'll call it 9.7. And if you were to look at a revenue multiple of approximately 20 around like a 20 type revenue multiple, what you do is we could do the calculation here. You get 20 divided by 9.7. So you get kind of a, hold on, this was incorrect. 32 divided by 9.7, you get a 3.29 difference. 3.29 difference between the revenue multiples of all the SaaSes, all these things with Clover. And that's when Clover was at 9.7 times revenue multiple. Now, if you do that, right, and if you take this type of ratio, okay, and you apply it to the ratio of where the stock should be trading at in today's present value, which we know they're going to make around $3 billion, you can see that once you multiply it times 3, or better yet, I don't want to, because I'm going to say something right now, and it's going to complicate the masses here. Let me just break it down really simply, okay? If we were just as simple, take the average of the highest SaaS and the lowest SaaS of a revenue multiple for Clover, you would get anywhere between 12 and go all the way down to 1. And the average will be exactly what this individual stated right here. Anywhere between 5 to 7. 5 to 7 revenue multiple, 5 to 7x. That's what I'm trying to say, but I'm giving it to you how you find it. But it's just, I'm gonna get my Wacom tablet and show you. I don't want to confuse you. Just think of it that way. So if they make $11 billion in 2025, you could just say multiplied by 7x, a revenue multiple. Let's be conservative. I'm going to do 6 to be conservative. That's 66 billion. Okay. Now, if you look at Clover Health right now, if you look at their stock, they're at $1 billion market cap right now. Well, they're at $1 billion and it's right around $2.29. Now, I'm going to be even more conservative. I'm going to call it $2 because then you would multiply 2.29 times that revenue multiple. I'm going to call it $2. Okay. You take this and you multiply it by 2, you're going to be at $132 based off of a revenue multiple of 6x. Okay. Based off of a revenue multiple, $132. If the stock market's clear and there's a lot of money printing, possibly after a recession, we're going to look at $132 stock price. I know that might seem too hard to hear, but you have to understand something here, guys. Okay, let me remove you have to understand something here, guys. Okay, we are in a dot-com bubble crash right now, okay? What we're experiencing is not a normal stock market. We're experiencing a stock market that is filled with fear. In fact, in our hedge fund information channel, what you can basically see here is you see the fear and greed model. We're at oh my God, we're at lows that we have not seen before. In fact, if you go back here, I placed an image for my comrades. We have still some space left to go. This is the fear and greed model dating back to 2004, and you can see that we still have some space to go. Well, I'm sorry, you can't see it here. If you go back to 2004, you can see this is the fear and greed model. We're at levels that we have not seen before. And we can see there's some space here that's left over that we might even go even deeper, right? And the deeper it is, the better. In fact, here's the bear market probability. We are going down in a downturn. Now, the question is, next quarter GDP, if it's negative, recession. If it's not, well, hey, soft landing, here we go, right? But very clear. So we can't get it twisted. Let me show you here. Smart money is going in. They're going in hard. While dumb money here in red, they're selling right now. And this is where money is made. This is why the rich get richer and the poor get poorer. This is why we curated our stock trades, right? And just like I told you, every time we get these extreme hits, after a year later, we get returns of 32% in the freaking S&P and NASDAQ. We get returns that are so paramount. Now imagine that's the global index. Imagine if you go down, or global companies. Now imagine if you go down to individual stocks. And I told you, look at the highest numbers here. Oh, there's 20. I said it. Technology. And here's another one that has the highest return. And healthcare. Technology and healthcare. A lot of idiots are buying energy now. A lot of stupid investors that follow the trend are buying energy because, it's been going up. Right? It's been going up. While smart money and people that are in our private Discord, I gave out a sell rating and I said, hey, it's time to sell your energy stocks. Sell this and hit our price target. Enjoy your 73% gain. And I said this back on February 11th, right here, right? Healthcare and energy. I'm sorry, healthcare and technology. Screw the energy, okay? All right, so there it is. So now let's go back into our monetized discussion for the Clover Assistant. And then we'll go through the questions here. All right, so let me share. All right, let's go.
State that we're in, let's say it's New Jersey or Georgia now. And let's say there's a lot of practices that are on Clover Assistant. There's well over 1,000 now in New Jersey on Clover Assistant that see Clover MA lives in Jersey, and they want to leverage Clover Assistant with their third-party MA plans. If for whatever reason those third-party MA plans don't engage in an honest way with those practices, what do you think those practices are going to do? What do you think that health system's going to do? We do have the more attractive product there. So then all of a sudden, the disruption gets created because of friction on the third-party MA side, because they're not giving them a technology product that's helping them make better decisions. So there's these structural things that are happening that I think will be clear over the next 3 to 5 years that will demonstrate we've got all these very unique tailwinds given how we've built our model and how we monetize. And I think you're seeing some of the signals with what Humana is saying around their growth challenges, or
you're seeing some of the signals of what Humana has on their growth challenges because Clover is kicking their booties. You understand what I'm saying? What do you think all this growth is coming from? It's not coming from nothing. Also, every freaking year, every day, 10,000 Americans turn 65 years of age. You got an aging population. I'm not saying we got to make money off of this, but someone needs to give them health care, and if it's going to be anyone, it should be them, because they're giving actual good health care. They actually care about the social determinants of health, the social stratifications of class, race, and gender, and all the things that are the reasons why medical students or pre-meds go to medical school to become doctors, to help patients, right? To put the needs of the patient first. To design a software by doctors for doctors, right? So it's a signal that you can parcel it. And another thing he just stated, he said something simple. He said you're going to see it in 3 to 5 years. In 3 to 5 years, you are going to see Clover Health like no other. And to be honest with you, honestly, I'm going to see right now where the stock price goes. I'm going to do my intrinsic value calculations every quarter. I'm going to go out 10 years, discount back at a 10, 15% discount rate using a 2% perpetuity model divided by the number of outstanding shares plus dilution, if anything happens with that. And we're going to get to a position where we're going to know where the stock is going to head before it even gets there, because that's what value investing is all about. Okay. All right. Let's get to it.
This obsession United has with acquiring Change Health, right? Like they've got to print these EPS kind of growth numbers. The reality is the model's broken. If you really start unpacking and they started revealing what they're making, their different segments, you'd see there's a real issue there.
So you mentioned kind of like an Agilon type model where you're helping physicians manage all of their Medicare book of business. Is it truly an Agilon type model where you're sharing upside, downside 50-50, or is it still kind of leveraging the doctors? You can stay in a fee for service world, will pay you more if you work with Anthem.
Yep.
But we'll take the risk, on that. Like, what kind of structure are we talking?
So we don't view ourselves in any way competitive to Agilon. And I think they operate a different, we're not in the business of helping manage practices, helping them run admin services, negotiating with MA plans for them. That I think there's a lot of organizations that do that well. I think they're one of them. That's not our edge. What we do like about companies like that is they're focused on empowering practices and helping them become more successful. I think there's a big tailwind behind that. We're really the intelligence layer behind that. So there's a lot of smaller versions of Agilon that we do work with that are much smaller that realize, well, wait a second, we're not going to build what you've built. We see how there's synergies here and we're happy to partner. So I would say it's not bespoke in the sense of that every economic model is completely different. But for us, it's really around how do we get into the right type of partnership with that practice versus obsessing into getting to a very specific type of economic model day one. Because the same way we enter an MA market, it's hopefully for a very long time, it's the same way as we think about it getting into a physician practice. Because for us, the land and expand can entail a lot of things. It allows us to build a preferred network. If it's on ACO REACH, it allows us to extend our software into more practices there. That allows us to roll out an MA plan if we so choose. So there's a lot of different ways we're able to optimize kind of gross profit over time. And I think that the powerful thing about it is we're in a market, however we're in a market, we're able to add gross profit without much OpEx. And that's really the journey we're on right now over the next kind of year and a half, 2 years, is that when we talk about those efficiencies, that's what's really exciting about it.
And so
and I understand there's a lot of people that are on the call that don't understand the finances and whatnot, which is, the whole point of creating this channel, to help break down stocks. But OpEx is essentially from what I understood, is essentially operating expenses. And that's what he's saying about that gross profit. They're able to expand on these different types of ventures and different types of pathways to get more revenue at an ability to not increase the operational expenses, which allows them to keep more of the money, which indirectly flows in our gross profit margins, which increases, right? And that's kind of the good part about it. Now, let me just go ahead really quickly. Hey, Al, I'm invested in Clover and was in the medical field before. I searched reviews. The feedback, how come the feedback is so negative? There could be some negative feedback, and sometimes the negativity outshines of all the positivity. But the best thing to do in your analysis should be focused on the fundamentals of the business, okay? The reviews, you can have the best reviews in the world, but if the company's not making money, then it's just a charity, Okay, I know that sounds terrible, right? But that's that's my business hat, right? So the company is doing well based off of it, the numbers. Their growth are great. Now, if the growth basically starts to dwindle, then they may have to start listening to those reviews, or something's intrinsically wrong with the company. And then things need to happen. Another one here, with all due respect, oil would keep going up because there is not enough investments in the sector during high inflation. Energy, agriculture, and healthcare outperform. Well, what I'm telling you is the stock market is forward looking. The stock market likes to look in ahead, and sometimes when the stock market looks ahead incorrectly, it then does a correction of a false correction that it did. What I mean by that is this oil stocks right now, they could continue to going up, but we're at a position where they're extending values far beyond far. Now, could they go up more? Well, of course, but you got to look at the risk reward ratio. Is the risk reward ratio worth it for energy? Well, based off of the graph I showed you, it's not. Technology, the risk and reward ratio of that is a lot better than energy. In fact, healthcare too. I hope that makes sense. And I was thinking, I don't know if it's going to be professional. I err on the side of professionalism, as I do want to get a helicopter hat, but I do try to err on the side of professionalism, especially because we just recently got featured on Bloomberg, MarketWatch, NASDAQ, and Yahoo Finance. And it's like they're going to feature me, and then they're going to see this guy with a freaking helicopter hat with the little TikToks, helicopter. But maybe I should do it. I don't know, just for fun, right? Who cares about those people, right? But I do want to thank them for featuring us in our platform. But yeah, let's go ahead and get back to Clover Health, and I'll go back to the questions here. All right.
When you think about the technology, I think the problem that a lot of times investors have from the outside looking in is like, everyone says they've got a great technology, so how do I look at Clover and say, I can clearly see from the outside that this is different than what other companies are talking about?
Yeah, I mean, I think it starts from the top. So this is the second healthcare technology company I built. The first one was Flatiron Health. That was probably the first successful health tech exit. My partner at Clover, Andrew Toy, built one of the most successful security companies for Android and sold it to Google about 5 years ago. And he is a security layer for every Android phone in the world. To build great technology, you need to have the best people and to pair. And I saw this.
Exactly. And if you look at Flatiron Health, their revenue is around $1.2 billion annually. And he built that. Okay. And it's just one of those things that, they're making money. They're making money. And it's in the data field, right? For the Flatiron Health. Another thing is Andrew Toy has made something very amazing with his software, I believe, with the Android services, with the communications, and then Google bought it out. So you have a track record of people that know how to build something sustainable and find gaps within the healthcare models to give to essentially merge them together and find solutions where doctors can use it and essentially make value everywhere, both in patients' lives and in the lives of the shareholders as well. So let's keep going.
This firsthand at Flatiron, you need to pair great technologists with really strong domain experts. And if you think about why has Musk been so successful with SpaceX and Tesla? He's been able to do that successfully. It's not an easy thing to do. A lot of the great technology companies typically are more consumer-oriented, not in complex industries like healthcare or space or defense or education. So it starts there. And typically, when a company run by what I would call someone more of like a suit type person, let's call it, who's never really built technology or built a technology company, it's very hard to hire a great technologist and treat that person as a partner and attract the right people. You typically hire someone and then you kind of dictate how things should be done. And that's not how great products are built. There's very little pattern recognition within whether it's upstarts or industry players and how to actually build great technology. So it starts there. I think kind of the second part is we're the only company out of all of those companies that has actually deployed software at scale with thousands of physicians with an 80+% engagement rate. And that's a fact. And those are the stats. So I think they'd have to demonstrate, well, where are those statistics that demonstrate that they feel they've got technology. Typically, it's technology where there's this deal signed and the practice has or downside risk, or they're fully capitated, or they own the practice. It's all these kind of contortions that where it's not free will, I would call it. But when you're doing that with physicians that don't work for you, where they could also be out of network and have the same zero cost sharing, well, then what is really the reason they're engaging with you? And then from a physician perspective, they really need to trust that software. And so even if you're building something that's really valuable, typically the business person at that healthcare organization will say, well, wait a second. We have to create the payment model that ensures that they're engaging with it the way we want them to. But then you change the behavior on the physician side, because then they're going to engage with the software in a way that either they feel won't penalize them on the payment end, or in a way that will help them get more payment. So by doing that, you've just ruined the integrity of the data interaction on that software. And so that's a core part of it, where there's no way to game Clover Assistant by engaging it in a certain way. You can't get paid more or less. So you can't help but just to use it to hopefully make better decisions. And then as a standalone software company, we're not subject to all the kind of IT up.
So I'm going to go ahead and increase the speed. What you guys can do, if you're listening on your mobile devices and computers, you can actually decrease the speed of this live. So to help you if it is going too fast, just so we can squeeze it all in. And yes, 80% engagement rate. That is impressive. And that's the data. That is impressive. All those doctors making that Clover Assistant perfect.
The upgrade cycles that you're stuck with all these legacy EHR systems, but we've seen a lot of progress within the technology component of CMS that has put a lot of oversight of EHR companies to do integrations on our terms. And we're no different around that. So we're able to maintain the integrity of our technology platform from an iteration perspective. And so what kills software is if you do integrations too deep, you can't roll out new features quickly and consistently and at scale. And everything I'm describing is just very foreign to most healthcare companies. Their eyes would kind of spin. But these are fundamental tenets if you're going to build great software for clinicians, or in general for anyone.
Yeah, that engagement dynamic is key, because you've demonstrated disclosed information, 1,000 basis points better in MLR when doctors are using it. I guess one of the numbers in the most recent quarter, the engagement as a percentage of MA members seemed to decline. How should we think about that number overall? What drove the percentage decline?
Yeah, the main driver of that was Georgia. So Georgia, we tripled our membership. And so the biggest indicator of whether a physician is willing to adopt Clover Assistant or not is if the Clover membership, I'm talking about the MA side, the Clover membership for that physician goes above 10 Clover members. Once you're below that number, you're not in the conversation. And psychologically, we think about why is that 10 important. So if you take, physicians are creatures of habit. They go about their weeks and they're dealing with all this stuff. But if you take 10 patients, let's say on average, they're seeing there's 4 visits a year per Medicare patient. So in general, they're seeing a Clover member once a week. And so just psychologically, when you think about just behaviorally, that's what's happening and why, oh, okay, yep, I see Clover members. They're not doing a count on their, you're at 10. This is just human psychology. And when you're building software, you have to understand the psychology of who you're asking to use your software. And so when we go into a new market, we don't go and try to convince physicians who have very few or no Clover members to utilize Clover systems that will not go anywhere. And so for us, it's really expand the membership. And then certain practices, we're seeing that now, obviously, going from a few thousand to 11,000+ in Georgia. In one open enrollment, we now have a lot more practices and physicians that have that 10 or more Clover members, and we'll see that kind of coverage level tick up. If we were just in Jersey, as an example, let's say all the new growth occurred only in Jersey, then you would have seen that immediate coverage numbers continue to go up and to the right. But because of the major growth in Georgia, that dynamic, that's why I picked that.
Yeah, so I guess when you think about that, that 10 member dynamic, I would have thought that having direct contract population would have factored into that. Does that include direct contracting, or does it only include the?
So I'm always talking about MA there. Our direct contracting lives, I don't have the exact sort of hold me to these numbers. I want to say it's about 2/3 to 3/4. I'm giving a little bit of a wide range of our direct contracting lives are in markets where we do not have an MA plan. So there's a smaller segment of those practices that are, but to your point, in those practices that happen to be in our MA markets, definitely very different type of conversation.
Yes, I guess why is that? I guess you're just targeting them differently. Like if you're saying direct contracting, I'm targeting you because you have a large Medicare population, not because you necessarily are going to be an MA.
We're looking at it under a 20-year timeline. So we're a founder-led company, founder-controlled company, not really going anywhere. Neither is Andrew, and so we're looking at how do we win in 20 years. So when we look at a market, it's really how do we think about this over the next 20.
That's huge. Okay. Just like with Jumia. Jumia is not a 20-year game. These are just for people that don't understand what Jumia is. Jumia is an African e-commerce company situated in Africa, but headquartered in Europe and have investments in different sectors of the Middle East. They are a e-commerce company that I don't think, honestly, the founders care. They just want to basically build a product and sell it to their highest bidder, Alibaba, Facebook Marketplace, Amazon, who knows, Tencent, whatever. They want to sell it to someone. With Clover, they have skin in the game. They're looking at this. How are they going to build this in 20 freaking years? They got a 20-year plus horizon. Same thing with our stock trades. I'm going to be here for 15, 20 years. And I'm going to be like, how am I going to build the best AI platform to assist our Discord members and our mastering stock market students to a point where they have everything they need to succeed in the market, just as, let's say, if a hedge fund would have. And we're going to get to that level. And if that's the mission and if that's the goal, we're going to get there, right? And that's the essentially way this, which is why I support this platform. I support Clover because they're looking at it from the long-term perspective. They don't basically make moves if the moves are not going to be in conjunction with their future mission, right? They're already doing that, by the way. The way they do their earnings report, they always like to beat. They like to under promise and overperform. Okay, all right, let's go.
The next 20 years, and for us, if we can work with an anchor practice that has enough of a base of lives, and that gives us our ability to deploy software there and learn in that market, we know we're going to win in 20 years. And it's being patient around that versus saying we have to have an MA plan in every new market. Because if I think about even on the personal investing side, the vast majority of my personal investments have been in early stage technology companies the last 10, 12 years. Same with Andrew. We have a ton of pattern recognition outside of healthcare on a personal basis on how companies win in industries, and you got to take a long view. This is not an industry where we're going to be able to take $1 billion and just throw it at growth, and no one's going to pay attention to the unit economics. That's just not the current space we live in within healthcare. So we have to create that mathematical edge. And that mathematical edge is find the right way to deploy our software to market at super low cost, and that allows us to extend there over time. But then again, you go back to the incumbents, they're not looking at it that way. It's very there's a centricity in terms of how they have to win in their model, and that is going to prove out to be a disadvantage for them over time.
Yeah, and so I guess one of the things that we think about your kind of pivot to proving out the economic model, the MA rate was pretty strong. I mean, does that make you change at all your view about how fast you want to grow versus how quickly you want to pivot to that profitability, dynamic? Or?
Yeah, I think we now have probably, I guess it's nine years of like on the ground intelligence on what consumers really care about, and they really care about choice, and choice in their minds really does come down to primary care. And if I'm sure most folks here, their parents or grandparents can afford traditional fee for service. Why do you want that? Because it's choice. You can go anywhere you want. That's just fundamentally it. And yeah, sub benefits are great and all that stuff's great, but people want choice. And especially if you think about the next stage of individuals entering Medicare, they definitely want choice. My mom's a Clover member, and I'm pretty sure if we didn't have choice in primary care, she would be sticking with fee for service. And so it's really kind of that fundamental. And so we've been watching kind of the growth models that are out there, and they just don't work for us. This whole kind of telesales, and you're not building a relationship. You're selling based on where your marketing dollars are coming from. I think we're seeing obviously a lot of cracks in that model now playing through. We've been talking about those cracks for the last couple of years because it just doesn't work for the consumer. And I'm not saying everything needs to be broker-led independent agent model, but it has to start with, are you giving the consumer the most important thing? And so when we see kind of rate book increases, this and that, we don't think about it as to how do we dump more of it into some benefits, this and that. We know we've got this very attractive thing that is unique to us because we know incumbents and others can't win in open access PPO. They might be able to win in a PPO where the cost sharing is super high and out of network for primary care. That's not choice. That's just sort of like marketing kind of BS. And so that's really how we think about it. And in the moment they do try that, their MCRs are going to go to the well higher than ours. And then someone in Minneapolis or wherever is going to be like, no, we got to bring it back. And we know how those organizations work. So we
someone in Minneapolis. Who the hell is in Minneapolis? I was just at Minneapolis. Remember, I was in Minnesota, right? Mayo Clinic. Who the hell is in Minneapolis? It's called Bright Healthcare Group, right? Oh, right. Listen, guys, just quick. I was looking over. BlackRock went ahead and increased their position stake by 6.16%. They pretty much now have an average at around $8.51. They own 5.6 million shares of Clover. They've increased it, and the last time they filed that was in May 12th. Now, I'm sure after this earnings report, in 3 months from now, we're going to see more of them go in. We have Group 1 Trading. They came in with a call of 1.4 million shares. They increased their position. They increased their position by 62% in calls, and they decreased their puts by 20%. Okay. So that right there. All right, let's go.
We just have to stick with what we know consumers really want.
So yeah, actually, because you've said a few times, it's hard to make money on PPO. So like when you look at industry enrollment, PPO has grown faster than HMO over the last few years, but you're kind of differentiating between PPO in name versus PPO the way you see it, which is very broad network access.
Yeah, I mean, I wouldn't say we're the only company that has a parity zero cost sharing with primary care, but I would bet we're the only company where that's our model. I'm sure organizations have a market or two where they've tried it or experimented with it.
And on the call, you talked a bit about the home-based capabilities that you have. Talk about a lot about the technology on the front end, but like the care delivery, how important is that? How scalable is that? What kind of investments do you need to make that work?
It's super vital for us. So when we were a few years in building Clover, we had to make a clinical and business determination for our most acute population. Do we partner with Oak Street? And do we partner with ChenMed? Do we partner with Iora? I spent a year talking to hundreds of physicians, just primary care doctors in various markets, not because we were entering the MA business there. I really wanted to understand, what do you think of these companies? And they hate them. And the reason they hate them is not because they don't have a good clinical model. I think they have great clinical models, but there is not one Medicare patient with 8 or more chronic conditions that does not already have a primary care doctor. So the challenging thing is those models create so much friction where physicians don't want their patients enrolling in those organizations' clinical models because they lose the patient, and that's a big revenue portion. Those patients generate 15-20% of their Medicare E&M revenue. That's a lot, even though it's only 4-6% of their panel. And so the problem with that is they tap out at 20-30% enrollment of those that are eligible because of these dynamics I described. And people in the market don't know who they are. But that 20-30% is still relevant for United or for Humana. But when I look, I'm like, what about that other 70% that's not getting access to that? There's a math opportunity there, and there's a clinical opportunity there. And how do you do that where you don't create competition in the local marketplace, where it feels like you're referring more to an oncologist or a cardiologist? What primary care doctors do all the time. No primary care doctor says, I'll handle kind of everything oncology related, built based on clinical need. And so we bought a small asset out of Signify 5 years ago. It's the only acquisition we ever made. And they had a small home-based primary care program because I needed a team that had that clinical know-how. And then we brought some folks from kind of CareMore and Oak Street and elsewhere. And we then built a home-based primary care model. The only physicians we employ are those home-based primary care physicians. So when we're enrolling, we're trying to get engagement around enrollment there, physicians aren't threatened by it. So they understand it's a clinical model, it's home-based. We're not setting up locally to take their patients. We're not saying they have to switch primary care doctors, but that might be the natural kind of evolution. There's obviously a whole kind of support team there. And we're north of 60% enrollment of clinical eligibles, double or more what you see in the marketplace. And on top of that, we're growing pretty fast. So that 6% would be higher if it was a steady state. And we've had COVID the last 2 years. We've had to run this program virtually the last 2 years up until February of this year. And there's no doubt we cannot drive the same clinical value when it's fully virtual. So we're excited about what we're doing there now, and we're on time. And then we just appended onto that our palliative care and hospice program. But you pair that with where you already have 60% plus enrollment of eligibles, we're at 90% plus enrollment into palliative care hospice for those who are eligible of that population. And that's really, it's those engagement stats that we pay attention to that win long term.
All right, great. Yeah, to your point, I think we're out of time. Cool. Thanks for doing this.
Awesome. Hey. It's a pleasure. Yeah, thanks.
Hey guys, seriously, if you can, try to get this video up to 60 likes if you can. It would really be really make me happy. The more we're able to like this video, the more YouTube, and I'm starting to understand YouTube now. I'm finally starting to understand how this works. The more likes you guys give, the more they're able to take this video and share it to someone who's interested, let's say in Bright Health stock. And we're like, hey, take a look at Clover instead, right? So take advantage of that. Like the shit out of this video, right? And try to get the video out there. All right, let's go ahead and do some really quick questions here, and then I'll go in and we'll do some closings. Oh yeah, and the population is set to double in the next 40 years regarding elderly. and Clover is going to be there for to catch that. Okay. I'll talk about the recent dark pool trading. So in our private Discord channel, let me go ahead and share the screen here. Let's go to our dark pool data here. Now, what we can do is we can take a look if there's any right now for Clover. So we don't see any dark pool for Clove here, but we can also go down to our other information here. We can look at old dark pool prints here. And we can see nothing really here. Let's see if there's any more dark pool. Let's see. Not really. To look at the all prints here. Okay, yeah. So here we are. So here's May 11th. We just got at $2.13 at a value of over $500,000. We got someone buying in. March 18, we got someone buying at $350 for $3 million. We got access to this in our Discord. If you would like, you can get access. We've been featured on all these amazing news outlets here at allstocktrades.com. So that's nothing new, but you can always constantly check it. But we already know things are about to roll in right now. Let's see here. That was me. Oh, hell yeah. We'll do some more. Thank you so much for sharing the video. You know, the more shares we get, the more it helps the channel, and the more we're able to do more stuff like this and find the next stock. It's very difficult, but I'm definitely up for the challenge. I think I understand the bull case pretty well, thanks to your hey man, it means the world. I'm very glad that I'm able to be a small piece here. There's hey Al, I know you're done the bearish projections, but what do you think sometimes you can possibly help us consider the bear arguments against Clover? Well, speaking about the bear arguments, if you go here to our brain machine, which is our proprietary software that we created at All Stock Trades, if you type in like DCF, Al DCF, you're supposed to type in the ticker symbol. You can look up any ticker symbol you want. It gives you the stock price. I mean, and this is more for like short term. Like this is like it's most definitely going to hit this price, right? It's like a short. Obviously, there's risks, market conditions, and whatnot. But you already know, based off of these levels, it trading at $2.29. The DCF is at $2.92. These are more for short term. So, I mean, in terms of like the bearish cases of it, I mean, the one that I can think of is analysts are going to continue trying to downgrade this. We had the street go ahead and issue a sell. We had one of the analysts raising it up to what, 50 freaking cents. I mean, it's unbelievable. So you know what I mean? But yeah, the challenges that it could have is it could get some lawsuits from all these incumbents. These incumbents can start creating problems. They could hire more short seller reports, but I think they tried to hit Clover so hard, and for Clover to survive this, it's pretty much done. I mean, it's pretty much good to go. I mean, they're pretty much good to go now. It's very, these guys know the business really well, and I just let's put it this way: all these people that give negative analysts and negative price targets, what is their bear case here? What is their argument? I haven't seen anything. Cash burn, but that's slowly decreasing as they become profitable. You know what I mean? Always like when I watch videos, things, hey man, it means the world. It means the world. I love clover leaves. Before I never liked the color green. Now I do. Hit that like button. Smash that like button, right? It's what the YouTubers say, right? We had a $7 target upgrade today. Yeah, so that $7, think about it for a sec. Let's do some calculation here. $7 right now. Okay, so currently, let's call it we're at a $1 billion market cap, $2.29. So what you can do is, let me just share the screen here. What you can do is you could take you could take the price, you could take that $7 price target, okay, divide by the current share price of $2.29. We're looking at 3x the stock price. Then you take the market cap, and we're looking at multiplying that by 1, giving you 3. So what this is telling you, and what this analyst is telling you, is that Clover Health should be trading at a market cap of a revenue multiple of 1, meaning that since they're going to make $3 billion this year, it's only fair to essentially give them a 1x revenue multiple. In fact, if we go in here and take a look at the revenue multiple currently for Clover, it's ridiculous. Let me just show you how ridiculous. We're looking at a revenue multiple right now of 0.5, okay? And it's going to be a lot lower, honestly, based off of the market cap, how it's been shrinking. However, if you look up, let's say, United Healthcare stock, UNH, and look up here, you're seeing a revenue multiple of 1.5. So that's exactly what he's trying to do. He's giving a price target as if they were just a insurance company, not a technology company. And like I stated, it's going to be the two sectors that are going to outperform is going to be technology technology and healthcare. Okay. Healthcare and technology. All right. So he's just pricing in a $7 price target, which is a 1x revenue multiple. So let's just say it as such. We know it's going to be a higher revenue multiple. Why would it be 1? But let's go ahead and say in 2025, they're going to make $11 billion. Well, if they're going to make $11 billion and we're currently at a $1 million market cap, all we have to do is just take times $2. So by 2025, they should be at $22. So what now, do the math. Right now, we're in 2022. We got 2023, 2024, 2025. That's about 3 years. Okay. So 3 years. And we're looking at right now a stock price of $2.20. Divide by $2.20 multiplied by 100. You're looking at a 900% increase, which is simple. You just type in, what is it, $20 or 22 divided by 2.2. We're looking at 10x your stock price in just 3 years based off of the current levels. So if you want to 10x your money from these levels based off of just a revenue multiple, non-SaaS like, not even, let's just say they still remain unprofitable, that's the price target. So I don't know how clear I have to be, but this is freaking undervalued as hell. Okay, I mean, you know what I mean. So you could look at the risk listed in the 10K. Exactly. So if you go to and this will be a great I would say a great practice. So if you go to our proprietary brain machine, you can open up the help menu. You can look up SEC filings, possibly here. And you go in and get the SEC filings by symbol. So you get this menu here. And then you can type in Clover. And then you get the SEC filings here. Now, it depends. Some of them are not annual 10K reports. So you're going to have to parcelate through them. but we directly get these reports directly from our private Discord. It's a software that I created to help our investors. But if you can go up and type in risks, investing in our securities involves risk. You should consider risk factors described in any accompanying prospect. Risk factors here, okay? And you go in here and I mean, this is honestly, this is going to be in our mastering stock market course, how to do these things, but it's honestly a great, we could just go ahead and look at it. So investing in our securities involves risks. Before deciding, and this is kind of a generic one, here comes my cat. This is kind of basically what it seems here, what they're saying here. But let me just get her off because she likes to scratch it. She thinks she's a lion. I'll just leave her. All right, so yeah, so that's how you find risks, and there's other risk factors as well. There's a risk section here, so I hope that was helpful. So that's how you do it there. It's funny to see people who write articles and just pretend we had. I know, it's so stupid. Even YouTube videos. I a couple quarters ago, someone saying, "Oh yeah, the stock price is down, so obviously the earnings was probably terrible." Doesn't even look at the earnings. You know, the hardest part about like being a first principles thinker is it takes time, but your knowledge is pretty much stabilized by algebraic, brick layered, strong foundation. To where if someone just comes in and gives you all these opinions, but the difference between what fact and if let's say if you don't know, you're able to research and to see if it's bullshit. There's a lot of bullshit in the market, guys. You just gotta be careful. It's just the kind of the nature of. I mean, let me share with you something. When I first started investing in the market, oh my god, like 10 years. It's been a while. I remember buying into a stock, and I saw this article, and I saw on the comment sections on Yahoo Finance comment boards, this is gonna go bankrupt. I'm like, oh my god, shit, it's gonna go bankrupt. And I just sold like an idiot. I sold because I really thought it was gonna go back. I know nothing about balance sheets, income statement of cash flows, discount, all these things that I'm telling nothing. So it's okay. I mean, so don't get too bogged down. It is what it is. You just gotta learn. It takes time. Pro tip: always use the brain machine. Hell yeah, and I appreciate that. Again, but hey, I know, right? She's a little lazy. She's lazy, dude. Hey, girl. Oh, wait. Oh, it's reversed. Sorry. Hey, you guys. Oh, thank you. Yeah, she wants to chill with the Al Stock Trades lion here. You can see the line on our upper right hand corner here. Only pussies on this channel, right? No. Okay, so all right. So Derek Newman, the president of investment. Yeah, I saw that. I actually spoke with him. He's a really nice guy. Very nice guy. Well, yeah, so I'm very happy that we went through this. Just very quickly for people that just tuned in, I recommend you watching the video again. But let me just go over this really quickly because I can't overemphasize this enough. Okay, so we're gonna go over this again. Smart money, dumb money. This is data collected by all investors. The blue are institutional investors. It would freaking help if I had it. So this is smart money and dumb money. Okay, the blue is smart money and the red is dumb money. Okay. When you're in your broker, whether it's TD Ameritrade, Robinhood, Webull, they take data on you and they sell that data. And we're able, using the University of Michigan Consumer Sentiment, the AII sentiment reports, we're able to basically compose a report system that basically parcelates the rich people and the poor people. As you can see, when the market's going down, the poor people are selling. Retail investors are selling. However, institutional investors, they're buying right now. So you don't be dumb. Be smart. You don't buy at all-time highs. You don't buy when the stock market keeps going up because it never keeps going up, right? You got to be smart because every time we got a downturn like this, if you just wait a year, just be freaking patient, wait a year, you get 32%, 94% of the time. All right. Even when you're at a panic at around this level, you're looking at an annualized return of over 25%. And again, after 1 year, especially when the panic button has been hit, stocks that tend to outperform are technology stocks and healthcare stocks. Whoever tells you, yeah, you got to go into materials, right? Materials look pretty good too, right? Energy is good. You got to do energy. You got to go in and don't listen to those. Okay. These are the ones that are going to outperform. You can go in, and for the people that are in our mastering stock market or in our stock alerts, what you can do is you can say, all right, well, since I know technology stocks are going to be the winning, I'm going to go in and I'm going to go to the sector rotation. I'm going to click on this. I'm going to go to technology. I'm going to say XLK. Okay, this is undervalued. And then I'm going to exit out of here. I'm going to go down to helpful links. I'm going to go all the way down. Someone posted it recently. I use this website, right? And you go to XLK and you go into all of the holdings here and XLK and you look at every stock. And then you go in our intrinsic value calculation, which is our DCF calculator, which looks like this. It looks like this. And then you do every stock. You analyze each and every one of these stocks and you say, okay, which one is any good? And then you would do other stocks. Like here it is. Here's another one. Enphase, right? You look at these stocks, you analyze them and you see which one is undervalued, which one has a future, which one's been down more, which one is like, Motorola, not too, which one has a higher weight. NVIDIA, Broadcom, Adobe, Intel, Salesforce, Texas Instruments, Qualcomm, Oracle, Intuit. And you do these calculations and then you go in and you utilize our brain machine, which is our proprietary software. Then you would go in and look at all of the dark pool data, the support and resistance lines and everything we offer at our stock alerts. And then you would make a sophisticated discussion all based off of these data points here of what's going to outperform. And that's how you get ahead of the market. It's that simple, right? But you got to know all this, you got to know how to, do all these things. It takes time, but that's the market, guys. It's really that simple. It's patience. It's patience. Okay. All right. So I hope that was helpful, guys. It was a privilege and honor. If you like this content, please don't forget to tap that dislike button. I'm just kidding. No, type that like button, right? Unsubscribe and turn off notifications. I'm just kidding. No. No, but for real, it really helps. Please share the video and all these things. And I laugh at my own jokes, even though I may not be funny. But I am thinking of getting a helicopter hat. I think I'll be like Forrest Gump, my name is Forrest. I like to look at stocks or something like that. Yeah, it's a privilege and honor, guys. I put in a lot of work. A lot of research has been gone into this, and it's really a privilege. Okay, and yeah. So have a wonderful night. God bless you, and please stay safe.